What if the most powerful investments of the last 20 years weren't the loudest, the riskiest, or the most talked about, but the quiet ones that simply endured? In today's calm documentary from Relaxing Facts Studio, we take a measured look back at history to understand which investments truly shaped long-term wealth and why. No predictions, no hype, no advice, just clear patterns revealed by time, data, and patience. By the end of this video, you'll see past market noise and headlines and gain a deeper, more grounded understanding of how value has actually been built over decades, slowly, consistently, and often when few were paying attention. A profitable investment over 20 years is rarely defined by eye-catching numbers or short bursts of performance. What matters is what remains after time has done its work. Nominal returns, the raw percentages often quoted in headlines, can look impressive, but they tell only part of the story. Once inflation steadily reduces purchasing power and taxes quietly claim their share, the real return is what determines whether wealth actually grows or merely appears to. Over long horizons, volatility becomes a test of endurance rather than a measure of failure. Markets naturally move through cycles of expansion, contraction, and recovery. Short-term declines may feel dramatic, yet history shows that their influence fades when viewed across decades. The long-term outcome depends far more on staying invested through those fluctuations than on avoiding them entirely. True profitability also requires a risk-adjusted perspective. Two investments may deliver similar long-term returns, but the one achieved with fewer extreme drawdowns historically offered a smoother and more reliable path. This is why professional analysis often focuses not just on return, but on how much uncertainty accompanied it. Lower stress, fewer forced decisions, and greater predictability tend to compound into better outcomes over time. Perhaps the most overlooked factor is consistency. One-time wins, exceptional years, or isolated successes rarely define long-term results. Instead, it is the ability to generate moderate, repeatable gains year after year that builds lasting value. Compounding rewards patience, not brilliance. Over 20 years, steady progress quietly outpaces dramatic but unstable performance, revealing that profitability is less about timing the perfect moment and more about allowing time itself to do the heavy lifting. Few financial stories are as quietly powerful as the long-term performance of the S&P 500. Rather than relying on individual winners, this broad market index reflected the combined progress of hundreds of U.S. companies across technology, healthcare, manufacturing, finance, and consumer services. That diversification mattered. When certain industries struggled, others expanded, allowing overall growth to continue even during uneven economic periods. A major source of long-term strength came from reinvested earnings. As companies grew, they retained profits to expand operations, develop new products, and improve efficiency. Over time, those reinvested gains fueled higher productivity and rising corporate value. This internal compounding, often invisible to short-term observers, played a central role in transforming modest annual growth into substantial long-term wealth. History also reveals that market drawdowns were not interruptions to the story, but part of it. Periods such as the early 2000s downturn and the global financial crisis temporarily reduced index values, yet recoveries followed as businesses adapted and demand returned. Each recovery reinforced a key pattern. The long-term trajectory depended less on avoiding declines and more on enduring them. Underlying this resilience was continuous corporate innovation. Companies within the S&P 500 evolved with changing consumer behavior, advances in technology, and shifts in global trade. Firms that failed to adapt were gradually replaced by more efficient and forward-looking businesses. This natural renewal process kept the index aligned with economic progress itself. Across decades, the S&P 500 did not grow through prediction or precision timing. It grew through diversification, reinvestment, recovery, and innovation. Quiet mechanisms that rewarded patience and participation over speculation, making it one of the most enduring examples of long-term wealth compounding in modern financial history.
Real estate tells a long-term story that is often misunderstood because its returns arrive from two very different directions. Property values may rise over time through price appreciation, while rental income creates ongoing cash flow along the way. Over 20 years, these two forces interacted differently depending on market conditions. In some periods, steady rental income carried most of the return, while in others, gradual price growth quietly did the heavy lifting. Location consistently shaped outcomes. Housing markets in expanding metropolitan areas benefited from job growth, population inflows, and infrastructure investment. Meanwhile, regions with slower economic activity often experienced flatter returns, even if property prices appeared stable on the surface. This regional variation explains why national averages rarely tell the full story of real estate performance. Borrowing added another layer of complexity. Leverage allowed investors to control larger assets with smaller upfront capital, magnifying gains during rising markets. At the same time, debt increased sensitivity to downturns, interest rate changes, and income disruptions. Over long horizons, leverage rewarded disciplined management and punished overextension, making it a defining factor rather than a universal advantage. What ultimately determined real-world results were the costs that never appear in headline figures. Maintenance, repairs, insurance, property taxes, and periods of vacancy steadily reduced gross returns. These expenses accumulated quietly, shaping net performance more than many initially expected. Real estate profitability, when viewed over decades, depended less on dramatic price spikes and more on sustained income, economic location, prudent use of debt, and careful cost control. History shows that properties delivering balanced, repeatable results, not just rising prices, were the ones that truly compounded value over time. Technology stocks have quietly transformed the landscape of long-term wealth, often in ways that went unnoticed outside boardrooms and investor reports. Over the past 20 years, digital innovation reshaped productivity across nearly every sector of the global economy. Automation, cloud computing, and mobile connectivity allowed companies to operate faster, cheaper, and more efficiently, creating ripple effects that fueled overall market growth.
Investors who recognized this transformation early found themselves aligned with a structural shift rather than a temporary trend. Scalability was a defining characteristic of successful tech companies. Unlike traditional industries, which required proportional increases in labor, equipment, or raw materials to grow revenue, technology firms leveraged software, platforms, and networks to expand rapidly. Each new user, each additional subscription generated incremental revenue at minimal cost, creating a compounding effect that propelled growth far beyond conventional benchmarks. Market leadership also played a pivotal role. Companies that achieved dominant positions often benefited from network effects, where the value of their products or services increased as more people joined the platform. This created a reinforcing cycle of adoption, retention, and profitability, making these firms resilient and difficult to displace, even during economic slowdowns. Yet, technology investing was not without challenges. Periods of overvaluation, such as the early 2000s dot-com bubble, reminded investors that rapid growth could sometimes outpace sustainable fundamentals. Corrections followed, pruning weaker players and leaving the strongest to continue their trajectory. Over time, these cycles highlighted a critical lesson. Patient alignment with innovation, combined with a focus on scalability and market position, delivered the most consistent long-term rewards. Technology stocks were not just growth stories, they were engines of enduring wealth, shaped by structural change and compounding advantages. Gold and commodities have long captured attention, not for explosive growth, but for their role in stability and preservation of value. Across decades, they have acted as natural hedges against inflation. When prices for goods and services rise, tangible assets like gold, silver, and industrial commodities often maintain purchasing power, balancing portfolios during periods when cash or bonds lose ground. This characteristic made them especially relevant during prolonged inflationary cycles, offering a quiet, protective function rather than dramatic gains. Their performance during crises further highlights their unique role. In moments of economic uncertainty, geopolitical tension, or financial market turbulence, gold historically outperformed many traditional assets, providing a safe haven for investors. Yet during sustained economic growth or bull markets in equities, commodities frequently lagged, demonstrating that their strength is context-dependent and tied more to preservation than accumulation of wealth. Supply constraints and demand shocks are central to understanding commodity pricing. Mines, harvest cycles, and global trade logistics create natural limitations, while sudden increases in demand, driven by industrial growth, technology adoption, or geopolitical events, can push prices sharply. These structural forces differentiate commodities from financial assets, which grow primarily through reinvestment and compounding. This brings us to a key distinction. Unlike stocks or real estate, commodities rarely compound over time. Holding gold or oil does not generate income, dividends, or internal growth, meaning long-term returns generally trail equities. Instead, their value lies in balancing risk, protecting purchasing power, and stabilizing portfolios. Over 20 years, the quiet power of gold and commodities has been their resilience, offering a consistent anchor in an unpredictable financial world, reminding investors that stability can be as valuable as spectacular gains.
Bonds and fixed income have quietly shaped long-term wealth by offering stability where volatility dominates. Unlike equities, which fluctuate with market sentiment and economic news, bonds provide predictable income over time. Interest payments arrive on a set schedule, giving investors a steady stream of cash flow that can be relied upon through both calm and turbulent markets. This predictability made bonds a foundational tool for preserving capital over decades. Interest rate environments played a crucial role in determining returns. When rates fell, existing bonds with higher yields increased in value, while rising rates could temporarily suppress prices. Unlike stocks, where long-term growth often overshadows short-term fluctuations, bond returns are highly sensitive to the timing of purchases and the prevailing interest climate, making careful selection and understanding of market conditions essential for maximizing performance. Bonds also contributed to risk reduction in diversified portfolios. Holding fixed income alongside equities helped smooth overall performance, cushioning portfolios against sharp equity drawdowns. During recessions or market corrections, bonds historically acted as a stabilizing force, protecting capital while providing modest, reliable returns. Credit quality and default risk were equally important. Government bonds generally offered near-guaranteed safety, while corporate bonds varied based on the issuer's financial strength. Strong issuers preserved principal and paid interest consistently, whereas weaker issuers carried higher default risk, which could erode gains. Over 20 years, the quiet power of bonds has been their ability to deliver stability, reliable income, and risk mitigation, demonstrating that long-term wealth isn't always built on explosive growth, but often on consistency, durability, and prudent preservation of capital across fluctuating markets.
Dividend investing has quietly built wealth for patient investors, relying not on dramatic stock price swings, but on steady, predictable income. Companies pay dividends in different ways. Some offer high initial yields, providing immediate income, while others focus on dividend growth, gradually increasing payouts year after year. Both strategies have their strengths, but over decades, consistent growth often outpaces high yield, thanks to the power of compounding and reinvestment. Reinvested dividends amplify long-term results. Each small payment, when used to purchase additional shares, grows over time, creating a cycle where income generates more income. Even modest dividends, repeated and reinvested across 20 years, can become a significant portion of total returns, demonstrating that patience and consistency often matter more than short-term gains or market timing. The companies behind dividends also differ from typical growth stocks. Mature businesses with stable cash flows and disciplined capital allocation are more likely to maintain and increase dividends even during challenging economic periods. This discipline reduces volatility, as dividend-paying firms tend to manage expenses carefully and avoid overextension, making them reliable anchors within a broader investment portfolio. Dividends also historically softened the impact of market downturns. When stock prices declined, the income component provided a buffer, helping investors maintain returns and remain committed through volatility. Over long horizons, this combination of steady payouts, reinvestment, business maturity, and resilience during declines allow dividend investing to compound quietly yet powerfully. It illustrates that enduring wealth often comes not from chasing the highest returns, but from strategies that reward consistency, patience, and careful selection, lessons the past 20 years have repeatedly confirmed.
History reveals that successful investing is rarely about intuition or chasing the next trend. It is largely a lesson in managing risk, timing, and patience. Emotional decision-making has consistently proven costly. Investors reacting to fear often sell during downturns, locking in losses, while excessive optimism can lead to overpaying during market peaks. Data spanning decades shows that avoiding these emotional traps correlates strongly with long-term success. Market timing, the attempt to predict short-term highs and lows, is notoriously difficult. Evidence shows that missing even a few of the best-performing days in the market can dramatically reduce long-term returns. In contrast, simply remaining invested, allowing time in the market to do its work, has consistently rewarded disciplined investors, highlighting the value of patience over reactive trading. Economic cycles further illustrate this principle. Different asset classes respond uniquely to expansions, recessions, and periods of volatility. Stocks, bonds, and commodities each have moments of strength and weakness, but understanding historical patterns allows investors to maintain perspective during downturns, recognizing that declines are often temporary while growth compounds over years helps reduce panic-driven decisions. Patience emerges as a central theme in wealth building. History repeatedly shows that waiting and allowing investments to mature quietly outperforms impulsive actions. Compound growth, reinvested dividends, and steadily appreciating assets accumulate value far more reliably than attempts to outguess the market. Ultimately, history teaches that steady, informed participation, tempered by emotional discipline and a long-term perspective, is more powerful than speculation. The past 20 years alone confirm that those who exercise patience and stay invested benefit from both stability and growth, turning measured decisions into lasting wealth. Across decades, one clear pattern emerges in nearly all successful long-term investments: the quiet, relentless power of compounding. Time itself amplifies growth, turning modest gains into substantial wealth when reinvested consistently. Whether through interest, dividends, or retained corporate earnings, repeated accumulation over years creates exponential effects that short-term performance alone cannot achieve, proving that patience is more impactful than timing or occasional windfalls. Successful investments also align closely with broader economic growth. Companies and assets that benefited from productivity improvements, technological advances, or expanding markets tended to outperform those disconnected from these structural trends. Growth was rarely accidental. It reflected participation in the real expansion of goods, services, and wealth across economies, reinforcing the principle that investing in the underlying progress of society often yields reliable long-term results. Durability through crises is another shared trait. Nearly every enduring investment survived multiple market corrections, recessions, or geopolitical shocks. Resilience mattered more than brilliance. Firms or assets that could withstand temporary setbacks
and maintain core strength consistently rewarded investors over decades, while flashy, high-risk plays often faltered under stress. Finally, simplicity proved surprisingly powerful. Straightforward investment approaches, buying broad indexes, reinvesting income, or holding quality businesses often outperformed complex strategies that tried to predict markets or exploit short-term inefficiencies. Complexity introduced errors, costs, and emotional stress, while simplicity harnessed time and compounding effectively. Together, these elements, compounding, alignment with economic growth, survivability, and simplicity, form the blueprint underlying long-term success. They reveal that wealth is rarely created by luck or high-risk maneuvers. It grows quietly, steadily, and predictably when disciplined strategies meet the natural rhythm of time and the economy. Over 20 years, this pattern consistently distinguished the investments that truly delivered enduring value. Thank you for staying with us through this calm journey into the world of long-term investing. If you haven't subscribed yet, now is the perfect time to join Relaxing Facts Studio and stay connected to insights that help you see beyond the headlines. If this video brought you value, please like it to help it reach more viewers. Share it on your social media so others can benefit, and leave a comment to tell us your thoughts or the ideas this video inspired. Your support ensures the channel continues creating content that educates, informs, and inspires for years to come.